Hello, it's Friday, the 8th of May. There's two obvious stories that I'm going to try and avoid talking about at any length today. The first one, UK local elections. The other one, of course, the Strait of Hormuz. I'm going to talk about both of them in a light touch way in order to provide a conduit, perhaps, to some more market relevant commentary. They are both, of course, relevant to an extent, but the question is, of course, how much. So in terms of local elections, I suppose it has been a bruising night so far for the government. Not a massive surprise. And again, I think what that really sort of brings us back to is what's in the price, and particularly, I suppose, when it comes to the government, what's in the price for the gilt market. That's a difficult thing to divine at the best of times. But of course, at the moment, you have these two major variables, the one being the local elections and the prospect of, a change of leadership in the UK government, and whether that would be a representation of a more sort of loose and perhaps laissez-faire fiscal approach, which is certainly one argument. At the other end of the spectrum, of course, you've got the conflict between the US and Iran and the price of oil and inflation and all the rest of it. So both of those events, the sorts of things you would expect to see push gilt yields up, and as I'm sure you've seen in recent weeks, they have done just that. The 10-year yield in the UK brushed 5% recently, and it's still at or around the highest levels it's been since 1997. So, yields are high in the UK at the moment. And of course, as a result of that, the debt burden is higher as well. We started the year with some, actually reasonable economic data coming through, but clearly in terms of, the cost of servicing the UK's debt burden, if yields stay at the sort of levels they are at for the foreseeable future, we come back into this conversation we were having last year about, the difficulty of servicing debt, the expense of just running that sort of running interest, and whether there's ways to use fiscal consolidation to start to make that debt more serviceable. But of course, if there is a change at the head of the Labour Party, the expectation is it will be a looser fiscal approach that comes out of it rather than a tighter one. So that's still finely balanced. The market today, what's in the price? Well, interestingly enough, gilt yields have actually come down just a little bit over the course of today, just a basis point or so. So nothing dramatic, but it's perhaps sort of a recognition of, while it hasn't been a great night for the government, perhaps marginally it's slightly better than what was in the price. Iran, very quickly, we've got both the US and Iran sort of talking about talking. There is some sort of notion of a deal to be done, but obviously, continued action which sort of makes that ceasefire look quite fragile. Again, what's in the price? There is clear signs of headline inflationary impact through, energy prices, cost at the pumps, and all the rest of it, not just, of course, in the UK, but around the world. And there are some signs of that starting to bleed into core inflation numbers, which is arguably the one that central banks will be more concerned around. That headline spike can be quite volatile and can come out of the wash quite quickly. But if you see people start to encompass it into or incorporate it into, cost of goods, for example, your transportation costs are going up, so you have to start putting up the price of things on the shelves. That then becomes more of a sort of core inflationary issue, and one that central banks are more likely to respond to. There are some indications of that cost sort of push started to come through, but still, it's not a sort of very strong connection. And again, market participants so far seem to be happy enough to look through that. And what do I mean by that? Well, let's look at what markets have done year to date to get a feeling for the overall context, and crucially, of course, the big theme really for this week's video, which is rotation, and perhaps we've seen a sort of change in leadership in markets over recent weeks. Year to date, equity markets are generally still up. They've had a period of sort of volatility following the end of February, which is when US and Israel started the conflict with Iran. Interestingly enough, the main leader since then has actually been the US stock market. It's sold off in concert with everyone else. It's actually rallied pretty well out of the back of it, whereas other markets, certainly developed markets, have really sort of had this conflict weighing on them. So for example, the UK was really sort of ahead in the build up at the start of this year, turning into a bit of a laggard. It's in fact in May just fallen behind the US year to date in terms of cumulative terms, whereas to the end of April, the UK was still actually ahead of the US. So it just goes to show the sort of the nuances at play here. Part of this, of course, is the US is doing really well in recent weeks, and a lot of that is in no small part down to earnings season. We've seen the US have a really strong quarter one earnings season. The reported earnings are very good, and by some measures, they're looking like the best in a couple of decades. Expected earnings growth over the course of this year, and so that's a strong picture for the US. And it's not just, although of course the sort of AI darlings and the firms sort of at the top of that index have done very well, are reporting strong earnings. It's not just confined to that cohort. Generally, there's a sort of a decent earnings picture coming through the piece. Clearly, that's all before the Iran conflict has come into numbers, but it's still a good start to the year for the US stock market. In terms of rotation, in terms of change of leadership, though, what is very interesting is to see how well emerging markets, Asia, ex-Japan, has done year to date. They're both up sort of double digits to the end of April in sterling terms, 13-ish percent for both of them. And it's interesting, perhaps different reasons depending on which one of those indices you look at. At one level, you've got a lot of sort of technology, which is doing pretty well on the back of this AI spend, for example, some fairly sort of concentrated exposures in those two groupings to that. On the other hand, of course, particularly in emerging markets, you've got Latin America doing well latterly as energy starts to sort of come to the fore, as oil price has spiked during this conflict. And indeed, looking around the world, certainly in terms of, to the 6 months to the end of April, energy and materials really sort of leading the charge, even in the US up until the end of April over that 6 month period, as you've seen a material repricing in oil amongst other sort of commodities, really sort of pushing up those sectors in the US and indeed around the rest of the world. And what's interesting about that, of course, is it represents a change of leadership from what we've seen over recent years. Another example of rotation, perhaps away from areas that have historically done very well to some unfavored areas having their day in the sun. And I suppose if you think about that, what it represents is stylistically value doing better than growth. And in fact, to the end of April, value stocks are up around about sort of 7% in sterling terms around the world, whereas growth stocks are only up a few percent. So some meaningful outperformance of value over growth year to date. And I think when you think about what is likely to catalyze a value rally, it sort of makes sense really. At the heart of that, you tend to expect to see some sort of change in the prevailing conditions. Really is the sort of thing that will catalyze value stocks. And the reason for that, of course, is because if growth is doing well in the sort of status quo, absent any sort of externality, you can sort of almost expect it to carry on doing very well. Whereas value is cheap because it's unloved, and generally there's a reason for that. For example, energies in the doldrums, materials not doing particularly well. So that sort of commodity element that sits underneath those, if that's sort of under pressure, you can understand why the stocks aren't sort of looking particularly healthily valued either. But a change in the value of that sort of raw material, the sort of fundamental componentry that those stocks are based on, or the valuation those stocks are based on, you can understand why they suddenly have a bit of a run. And so the reason that value sort of can suddenly come to the fore is there's some sort of change in the mood music behind the scenes that really sort of changes the dynamics. And that's why when we think about building portfolios, rather than trying to lean too extensively into any one investment style, for example, through active managers, or any one particular sector or region or anything else, we want to be diversified in terms of the exposures in the portfolios, because predicting what's going to catalyze a market change is inherently very difficult indeed. Anticipating any sort of conflict, for example, or geopolitical tensions, as an example of the sorts of areas where you can start to see change come through that will benefit unloved stocks is, of course, very difficult. So rather than try and predict that and chase your tails, what we'd much rather do in the Liontrust team is keep a diversified basket of these different investment styles in play at all times, given value alongside growth, alongside quality, and indeed smaller companies, to give us that sort of blend of stylistic exposure through active managers in each of the equity regions. Likewise, in terms of different asset classes, you want some fixed income to complement the equities in portfolios. And interestingly, we've seen a lot of sort of reporting around, fixed income sold off, of course, in that sort of initial inflationary concern as the conflict between the US and Iran started. That has sort of stabilized, really. And I think, what you are seeing is, as much as you've had that sort of inflationary impact in prevailing yields, the overall impact in terms of the fixed income markets hasn't been severe year to date. And I think it represents a degree of differentiation from the equity markets, and again, demonstrates over the sort of medium to long term why we think they remain very valuable and useful diversifiers as a multi-asset portfolio component. That's it from me. Have a good weekend when you get there, and we'll see you next time.